AS1 Disclosure of Accounting Policies. So, what are the fundamental accounting assumptions? Going concern, consistency, accrual. What is going concern? Let's see. The financial statements are normally prepared on the assumption that the enterprise will continue its operation in the foreseeable future. That is known as going concern. So, on what basis the financial statements are prepared? On the assumption that the enterprise will continue its operation in the foreseeable future. The operations will go on, and that is known as going concern assumption. And next one is consistency. The principle of consistency refers to the practice of using the same accounting policies for similar transactions in all accounting period. So, in all accounting periods for similar transaction, we have to follow the same accounting policies in order to be consistent. It helps in comparability. Now, let's see what is accrual basis of accounting. Under this basis of accounting, transactions are recognized as soon as they occur, whether or not the cash or cash equivalence is actually received or paid. It doesn't matter whether the cash or cash equivalence is received as of now. If the transactions are recognized as soon as they occur. So these are the three fundamental accounting assumptions. What are they? Going concern, consistency, accrual. And if these assumptions, fundamental accounting assumptions are followed, it need not be disclosed in the financial statement. As per AS1, if the fundamental accounting policies are followed, it is not required to be disclosed. But if it is not followed, disclosure is required in the financial statement as per AS1. Now, what are accounting policies? Those are specific accounting principles and the methods of applying these principles adopted by the enterprise in the preparation and presentation of financial statement. So, there are several accounting principles, and what method of applying these principles adopted by the enterprise? What method is used by the enterprise for applying these principles? That is known as accounting policy of that enterprise. So, accounting policies are specific accounting principles and the method of applying these principles adopted by the enterprise in the preparation and presentation of financial statement. For inventories, the accounting policy can be FIFO or LIFO. For cash flow statements, it can be direct method, indirect method, likewise. That is accounting policy. Now, let's see what are the selection criteria. On what basis the accounting policy has to be selected. So, selection criteria, there are three: prudence, substance over form, and materiality. Let's see each thing individually. So, prudence means that in view of uncertainty associated with future events, the profits are not anticipated but losses are provided for as a matter of conservatism. So, if there is an uncertainty related to future event, we will not account for the profits, but we will definitely provide for the losses. That is known as prudence. Now, what is substance over form? Transactions and other events should be accounted for and presented in accordance with their substance and financial reality and not merely by their legal form. So, the transactions and events are to be recorded on the basis of their financial reality, like what it represents, rather than legal form, rather than what it appears. So, transactions and events have to be recorded on the basis of their financial reality and not merely on the basis of their legal form. Now, what is materiality? Financial statements should disclose all material items that might influence the decision of the users of financial statement. So, if it is seen that it would influence the decision of the users of financial statement, it definitely need to be disclosed. So, these are the selection criteria. What are they? Prudence, substance over form, and materiality. Now, let's see what are the disclosures required as per AS1. All significant accounting policies adopted in the preparation and presentation of financial statements should be disclosed. So, all significant policies has to be disclosed, and all significant policies should be disclosed in one place, and it should form part of the financial statement. So, these are the 3 points relating to disclosure. What are they? All significant accounting policies adopted in the preparation and presentation of financial statements should be disclosed, and it should be disclosed in one place, and it should form part of the financial statement. We have already seen another thing that if fundamental accounting assumptions are followed, it need not be disclosed. But if it is not followed, it has to be disclosed. It is on the matter of fundamental accounting assumptions. But there are many other accounting policies, right? All those significant accounting policies has to be disclosed, and it should be disclosed in one place and should form part of the financial statement. Now, when can we make changes in the accounting policies? On three situations, we can make changes in the accounting policies. What are they? If it is required by law or statute, if the law says that we have to change the accounting policies, it has to be made. Then, if it helps in the compliance with accounting standard, so in order to comply with the accounting standard, a change is required, then we need to change the accounting policy. If the change, third thing is, if the change gives more appropriate presentation of the financial statement, so if the change is required for more appropriate presentation, it will help in better presentation of the financial statement, then the change is required. So under three conditions, the change can be made. If it is required by law or statute in order to compliance with accounting standard, and if the change gives more appropriate presentation of the financial statement. On these three conditions, changes in accounting policies can be made. So now the changes are made, and if it is material in the current period and if it is not material in the current period, let's see what we have to do on the as per disclosure AS1. So when the change in accounting policy is material in the current period and the amount is ascertained, the amount has to be disclosed as per AS1. So, and if the amount is not ascertained, the fact need to be disclosed. So, the change in accounting policy leads to material in the current period. If it is material in the current period and if the amount is ascertained, the amount has to be disclosed. If amount is not ascertained, then the fact has to be disclosed. And the second condition is, when the change in accounting policy is not material in the current period but ascertainable in the later period, it is not material in the current period but it can be ascertainable in the future period, then in the current period, do we need to do something? Yes, we have to disclose the fact of such changes in the later period to be disclosed in the current period. In the current period, we have to disclose the fact even though it is not material in the current period. So, the change in accounting policy, material in the current period and not material in the current period but ascertainable in the later period. If it is material in the current period, amount is ascertained, the amount has to be disclosed. Amount not ascertained, the fact need to be disclosed. Not material in the current period but ascertainable in the later period, then the fact has to be disclosed in the current period. Hope the AS1 is clear.